we're going to continue our discussion on the accounts receivable and the allowance for doubtful accounts that we talked about the other day. So if you remember, the matching principle says that we have to match all related expenses with the time period we make the sale. So when I make a sale, I have to record the bad debts. And remember, it's in the same time period, so that time period is in the year, not necessarily day by day. So by December 31st, I have to say, of all my sales that haven't yet been collected, what percentage or what amount of those will go bad? Well, obviously, if I only sold it yesterday, I don't know. So what I do is I do an estimate. So we're going to talk about the estimate. Okay, so if I make that estimate, my journal entry would be uncollectible accounts expense. You would want to credit accounts receivable, but the problem with crediting accounts receivable is I don't know whose it is. In accounts receivable, I have to indicate whose name it is. So I have a temporary holding account. We talked about this in class the other day. I have a temporary holding account called the allowance that's going to keep track of them. So an important point is, and I've got the entry written both here on your handout and over here, is please know you have two entries. One is to set up the estimate. So if you see in anything the word estimate, you see some word that implies an estimate, it will be this entry always. So don't worry about the amount, just debit uncollectible accounts expense or bad debt expense. I tend to call it bad debt expense, and credit the allowance for doubtful accounts. Okay, so I want to talk about this allowance for doubtful accounts. So what happens on your balance sheet is you have accounts receivable, and I completely made up this number, so it doesn't relate to this problem at all. I have $100 in accounts receivable, and I am estimating that 10 of those accounts receivable will not be collected. So notice allowance for doubtful accounts is a credit, so I credit it for 10, and if these two accounts, just like equipment and accumulated depreciation, these two accounts always go on the balance sheet together. And we call the value the net realizable value. So the net realizable value of accounts receivable is $90. So on the balance sheet later on, we'll see the line accounts receivable less the allowance of 10. So my net realizable value is $90, and that's pretty important. Okay, so this slide just says that is that. So we'll go on. Okay, so then what happens when I do know the name of the person, when I figure out who it is that's not going to pay me? Because I knew that $10 worth, or in the example that they showed you there, it was $10,000 worth. So I'm going to get rid of this stuff. Okay, so we knew that $10,000 would not be collected in our estimate. Now we know whose it is. So once we know whose it is, we can take it out of the allowance, because I no longer have to allow for it, which means I don't know whose it is. It's my estimate, because I know whose it is, and I can take it out of accounts receivable. So notice you better memorize these two entries: to set up the estimate, debit the expense, credit the allowance; to write off an actual account with a name of a person. So notice this one is discount stores. You take it out of the allowance and you credit accounts receivable. Here's an important thing. Sometimes students have trouble that we get rid of it in accounts receivable. We get rid of it out of accounts receivable because it's no longer an asset. However, the business itself sends it down to the credit department, and the credit department starts working on it and trying to collect it. So this account is not forgotten about. It's just no longer an asset. And an asset means a current or future benefit. And if you're not going to collect on it, it's no longer an asset. So this slide, if we look at this one in comparison with this entry, so notice that I take it out of accounts receivable and I take it out of the allowance. So if I have $250,000 before the write-off, and I had $10,000 in my allowance, I have $240,000. So notice I took it out of accounts receivable, so accounts receivable went down by the $4,000 that I wrote it off, and look at your previous entry or previous slide, and I took it out of the allowance, so allowance went down for $4,000. So notice, this is pretty important, your net realizable value has not changed. The reason your net realizable value has not changed on a write-off is because I already estimated for it, and I already allowed for $10,000 to be written off, so when I have a write-off, it doesn't affect it. Okay, so remember these two entries. This entry to set up the allowance based on an estimate, this entry to write off an account. Those two entries will always be there under the allowance method, and I'll come back to the direct write-off method later, but this is the allowance method. All right, so let's go down to here. There's two ways to set up this number. In both of these ways, the debit and the credit are the same. It's the number that changes. So again, if you see estimate, you're going to immediately debit uncollectible accounts expense and immediately credit the allowance. But the amount that you're going to do it depends on which way you're going to do it. So I have two methods to do it. One's called the balance sheet approach, and one's called the income statement approach. Under the balance sheet approach, I'm going to analyze accounts receivable to figure out how much goes in the allowance for doubtful accounts. And so why is it called a balance sheet approach? Because accounts receivable is an asset. So I look at an asset to determine how much goes in the allowance, and the allowance is a contra asset. So both of them are on the balance sheet. Asset, contra asset. Okay, so in this particular one, I've got it on your handout so you can do this. I say, here's my accounts receivable. So my accounts receivable is on my books for $100,000. Based on past estimates, 1% of this will go bad, not yet due, but notice the older they get, the more subject they are to going bad. So I have seen them that have over 180 days and they'll have 100% or 90% or a real high percentage due. These have to be given to you. You cannot come up with these by yourself as a accounting student. The business will determine it based on past experience. And so I simply, this is given. So I simply just take it. 510, 29,000 times 0.03 is 870, et cetera, et cetera. So now I know that 56,860 of my accounts receivable will go bad. Okay? And that's the balance I want in the allowance. Okay, so here I've got a little picture of my accounts receivable T account. So notice it has the 100,000 in it. And my allowance, and if I say record the entry to set up the allowance, assuming the allowance already had a credit balance of 4,000 in it. So my allowance is sitting there with 4,000 in that, and I want it to be 5680. So if I want it to go from 4,000 to 5680, I need to add another 1680. So remember, your two entries up here. I can't get to them. Okay, your two entries up here. One to set up the estimate. I am setting up the estimate, so I need an uncollectible accounts expense and allowance for doubtful accounts. So how do I know that I'm setting up the estimates? Because these are estimates. You don't come up with percentages on estimates. You would come up with people's names on estimates. So based on past experience, etc. So I debit uncollectible accounts expense and credit allowance for doubtful accounts by 1680. So notice in this little statement, I adjust to the computed amount. So I want my accounts receivable to be my 5680, so I add 1680 to it, so it is 5680. So I want you to do one more thing and look at what is your net realizable value. So let me pause. Okay, so my net realizable value is the balance in accounts receivable of my $100,000 minus the 5680. The final balance in my allowance is 943.20. So that is what would appear on my balance sheet as an asset, net realizable value. Okay, so remember that net realizable value, the 94,320. So remember that, that's pretty important. Okay, so our net realizable value using the balance sheet method is 94,320. There's another method that we have, and that's called the income statement method. On the income statement method, I look at sales to determine how much goes into bad debt expense. So again, I have the same first entry, uncollectible accounts expense, which is the same as bad debt expense, and I credit my allowance. So instead of trying to figure out how much goes in this account, I'm figuring out how much goes into this account. Because this is an expense which goes on the income statement, and this is a revenue which goes on the income statement. Thus the creative name income statement approach. So in September, we had credit sales of 1 million or 150,000, and historically 2% of their credit sales has been uncollectible. So the estimate, so again, I see I've got a 2%. I look through this doesn't have a name, it's an estimate. So I have the entry, the debit and the credit, always debit uncollectible accounts expense, credit allowance, because I have an estimate. Now my question is how much? Assume the allowance had the $4,000 credit balance. So I have a $4,000 credit balance. Under the income statement approach, I don't care. And the reason I don't care is because I'm trying to figure out how much goes into uncollectible accounts expense, not the allowance. So I've got 2% of credit sales have been uncollectible. Assume the allowance had a $4,000 credit balance. So right now, since I'm looking at sales, not accounts receivable, I can cross that off. I don't care. And so my journal entry is $150,000 times 2%, so $3,000. I want $3,000 into uncollectible accounts expense. Notice I only do this journal entry once a year. Okay? Notice they have it on September 30th, but you generally do it once a year for our purposes. Uncollectible accounts expense, remember the last test you took, we zeroed it out. So I can do the same thing with allowance that I did with the allowance under the other method, but it always starts at 0. So I want it to go from 0 to $3,000. So the entry to make it go from 0 to $3,000 is actually debit uncollectible accounts expense and credit the allowance for $3,000. Now I want to do one more thing. Here, let me. Okay, so I added $3,000 to it. So while you ignore the $4,000 for your entry, you don't ignore it for the balance. It still has it in there. My allowance had $4,000 in there. I just added another $3,000 here, so now it has $7,000. So under the income statement approach, my net realizable value is $93,000. Under the balance sheet approach, notice it was $94,320. Okay, so you will use one or the other. You cannot use both. You can only use one or the other in a specific business. So I wouldn't have two net realizable values. If I use the balance sheet approach, I'd have this one. If I use the income statement approach, I would have that one. Okay, so now let's talk about what happens if an item we wrote off, they later pay. So I'm going to go right back up to here, and notice this is my write-off entry. So I have two entries. Set up the estimate. I'm looking for the words estimate. I'm looking for percentages because you don't ever write off things in percentages. You write off things in dollars. And so this is my entry. When I write it off, I need to get it out of the allowance because I no longer need my estimate holding account, and I take it out of accounts receivable because it's no longer an asset. What happens if this person later pays? Well, look at this. I flip it. I simply put it back into accounts receivable and credit the allowance. So I flip this journal entry because I shouldn't have written it off, and then I show I collected it. So it's two entries, debit cash and credit accounts receivable. The final thing in this chapter regarding accounts receivable, or this video that I'm going to talk about, is the direct write-off method. It's important to know that there are two overall methods for accounting for bad debts: direct write-off and allowance. How do you know the difference? The allowance has the allowance in it. Okay, it will say the word estimate. The direct write-off will not have the word allowance in it, nor will it have the word estimate. So look at this. This one debits uncollectible accounts expense, credits the allowance. When I write it off, it debits the allowance and credits accounts receivable. Squish these together and you'll notice that I credit the allowance and debit the allowance, and I don't have the allowance in the direct write-off. So squish these together and see what you have left. You debit the account uncollectible accounts expense and you credit accounts receivable. So this method, we show it in this book. You need to know it exists. You need to do some in your homework. I won't necessarily test you on it because it's not allowable by GAAP unless its effects are immaterial. And why its effects would be immaterial is if sales on account is so low compared to overall sales, it wouldn't really matter if you did it wrong, because remember, we ditched the last 6 zeros on financial statements anyway, and so chances are that if you have very few sales on accounts, it's not going to affect your numbers in the rounding part. So if you use this method, you just wait until an account goes bad, and so now I can debit uncollectible accounts expense, and since I waited and didn't make an estimate, so I violated the matching principle, in other words, I can take it out of accounts receivable. Remember, the only reason you can violate the matching principle is if the effects are immaterial, and immaterial, remember, means too small to care about. So that concludes our discussion of bad debts.